Good morning from our world headquarters in New York. I'm Manus.
And from our studios in London, I'm Danny Berger. Welcome to The Brief. Let's set your agenda.
A well-telegraphed pause. Policymakers are poised to hold for a second straight meeting as bond traders brace for the Treasury's quarterly funding announcement. On standby, Japan's top currency official says he's ready to intervene in the FX market if needed. The BOJ announced bond purchases as yields touched a fresh decade high. And Antony Blinken is set to head back to Israel. Dozens of people were killed and more wounded at a Gaza refugee camp, stoking concerns about the mounting toll from weeks of fighting. Very good morning. It's the Triple F that is driving the narrative of risk. It is fear of intervention, it's funding, and of course it is Fed Day. What will happen? What will the move? How hawkish will this pause be? But if you are fearful, you've had a message from the Bank of Japan and the Ministry of Finance. The Ministry of Finance are looking at this too big figure move on dollar yen, and to them that is a trigger warning. That next level in the dollar yen market is 152. We've seen an unscheduled level of bond buying in the market. There's a message from the regulatory officials. They stand ready. Kanda at the Ministry of Finance. We are ready. We're on standby. And of course, that underwhelming tweak in yield curve control saw dollar yen really move. The next trigger level is probably around 152. Now, when it comes to the bond markets, of course, we've had a skirmish with a decade high in the bond market. This triggered the response mechanism, which was unscheduled buying. I love the line that I've had from a broker overseas this morning. The Bank of Japan will not get sucked into line drawing. They will be much more dynamic in terms of what they do. But where is the risk that the Japanese lose control of the long end of the curve, as the Fed did? Much less likely. They own 60% of the market. And of course, two-year yields when it comes to what happens with the bond market. Obviously, Mr. Druckenmiller went to lunch or dinner with Bill Ackman and Bill Gross, because Druckenmiller at Duquesne says he's got massive long bets on two-year yields. So he is fearful. And of course, it's all about the data, Danny, that he's fearful of. Good morning.
Good morning, Manus. I got your equity check for you this morning. We're at the lows of the morning session for futures in this U.S. future trade. S&P and NASDAQ futures down just less than 0.4%. It is another busy day with a lot of earnings. We're going to hear from Qualcomm, for example, a lot of others, Airbnb. And within all of this, for the NASDAQ, we are just a little bit more than 24 hours away from Apple earnings. Citi says that investors are piling up on options that will protect themselves should Apple disappoint. To give you an idea of what we're prepared for, we did hear from JP Morgan Asset Management's David Kelly, who says that the rout has meant valuations are more in line. Don't buy tech yet, buy value. Finally, European equities, Manus, those doing better this morning, up about 0.1%. A lot of earnings means that there's a lot of divergence in this index. Companies like Ørsted, a big wind turbine maker, pulling back from the U.S. That sinks. But we had some more positive earnings from retailers and drug companies this morning. Now, Manus, we're, of course, waiting for the big Treasury financing announcement and the Fed. But I got to pose the question, does it really move markets? How much do we care? I mean, a lot of it is so known. We expect $114 billion, that to be the announcement. We expect the Fed to hold. Is it instead the data that continues to bully this market? You mentioned Druckenmiller talking about the poor anecdotal evidence. What about the U.S. consumer yesterday? Consumer confidence, Manus, yesterday fell to a new 5-month low.
Yeah, but then, of course, are you going to look at soft data or hard data? Because, OK, the consumer may be running out of stimulus checks, but then there's the other side, which is the employment cost index. And, of course, that is pumping hot. And that, in theory, is what the Fed are most preoccupied about. Higher for longer based on data dependency, or will it be higher for shorter based on data dependency? Danny?
Yeah, it's a very good point, Manus. Of course, we do expect to hold. Yesterday, for the BOJ, a lot of differences in what we expected. And what we got was maybe a confused tweak to yield curve control. We spoke yesterday about it with RBC Blue Bay CIO Mark Dowding, and he had told us that the yen risks falling towards 160 against the dollar if the BOJ buys more bonds. Listen to what he told us.
If it is being forced to intervene to buy more bonds, effectively you're delivering more dovish monetary policy. This is going to undermine the yen, and you can see scenarios where sort of dollar yen is heading towards 160, and investors essentially concluding that BOJ policy is a model and that UAID is making a policy mistake.
Joining us now is Ella Hoxha, head of fixed income at Newton Investment Management. Ella, great to see you on this very busy week.
Good morning.
Somehow, the Bank of Japan handed out a decision that resulted in probably the opposite of what they would wanted, that is, yields higher and yen weaker. Did the BOJ undermine itself yesterday?
Possibly. I mean, judging by the reaction in financial markets, I think in terms of yields, you did see flattening further out in the curve. So that's telling you not fully, but perhaps related to positioning as well. Now, currency is probably the more telling. And as you were quoting Mark earlier, it's hard to stop that unless you change the dynamics in terms of interest rate expectations, right? So in a way, they have sort of shot themselves in the foot. Now, I think that's sort of like the more short-term implication. Further out, the implications from inflation and wages rising in Japan do mean that the BOJ gets the message and that they will be moving in that direction. But I guess it's a case of steps, and they're being very timid here. And, of course, the market's punishing them for it in terms of the dollar-yen move.
Good to see you this morning, Alex. So you say they shot themselves in the foot, and what went through my mind is, you know, you've got a much more louche or laissez-faire FX market relative to the bond market, and I think that's where the test is going to come. There's been 2 tweaks by the Bank of Japan, and as you say, they have shot themselves in the foot. So how much of a test of the metal will the FX market take it? Where will the Bank of Japan be dynamic, or will they try and draw a line in the sand on the dollar-yen move?
Well, the only way for them to do that is by raising rates, first of all, away from negative rates, but also more close to where rates should be in a normal environment, which you can argue is something that the Bank of Japan has not faced for a very long time. We're talking decades. And so that's probably the only way that you're going to arrest this move. Of course, on the other side of that, you have the Fed. So you do need some stabilizations in the long end of U.S. rates, for example. That's one of the other factors that's been driving this move. So it's interest rate differentials. And so it's very difficult to say how that pauses without a shift from the BOJ itself.
Now, today, we're going to get the Fed, we're going to get the quarterly refunding announcement, and so much has been made of that announcement. Plenty of commentary out there saying it's more important than the Fed. I kind of started the show with this, and I want to pose it to you because we have a pretty clear idea of what's going to be in that announcement. $114 billion in combined sales is the estimate. I mean, what are the chances that this is actually a market-moving event today, at least?
Well, you have the Fed event as well, so perhaps the two combined could have enough. I tend to think that if something's out there, it should be reflected in price action. So I would, my view would be limited effect at least from this announcement. The Fed in itself is probably more of a risk factor, certainly on the language. If they use language that acknowledges that nominal growth has been higher than they would have liked, and that even if we come down, we're coming down from very high levels, that potentially has more probability of disrupting rates further rather than the other announcement.
Right.
I mean, if we look across the markets, equity markets have dropped for 3 months in a row. Some people are saying that's the equity market desperately trying to catch up with the bond market. But you make this point on treasuries, and this is interesting. There's good asymmetry in treasuries for you at the moment. 100 basis point rally can give me 12% plus, and if a similar magnitude of a sell-off, of course, you stand to lose around 2%. So bonds are starting to look interesting relative to cash. Where on the curve is it most interesting? And are you a duration hunter? Would you like to wear that title today?
It's a very dangerous title for the moment. I mean, look, we have, we have some duration in the portfolios, right? Relative to where we could be or relative to our history, we're certainly probably more in the middle of the road. And the reason for that is we want to wait this risk events that we have, particularly the ones today, to sort of pan out. And also we want to get a little bit more clarity on the cycle, which is not clear to us, right? That means that we're not maxed out on duration. But of course, we stand by this view that in asymmetry terms, you can make more than lose in treasuries here. Now, there is, of course, a risk that you can sell off another 100 bips from here. I mean, we are running pretty high nominal growth in the U.S. That is a scenario we have to consider. And there is a possibility that the Fed can re-engage with rate hikes. And so that does put bonds under pressure. Now, I would agree with Druckenmiller in terms of the front end of the curve. That has been interesting for us, and that's where we've been shifting more of our exposures in terms of
But would you be willing to do what he's doing, a massive bullish position? I don't know what massive means, but would you be willing to go massively into that?
When he says massive, he really means massive. I don't know. I can match his firepower. Also, he's running his own money, so it's a little bit different. But I mean, jokes aside, yes. I mean, I would say on a scale of, I don't know, 1 to 10, I would say we're probably more close to like a 6 out of 10 right now. So I think it still pays to be a bit cautious on rates. I think vol is pretty high. And I do worry about this element that I was talking about. What if we are wrong and 5% is not the trigger for the Fed and we actually can go higher to 6%? You have to allow for that probability. I don't think it's our core case, but it's a risk. And so we're managing the risk in the portfolios with that in mind.
Yeah, I mean, folks who started out confident this year that it was the year of the bonds were proven very differently. So fair enough on the cautious point. Ella, thank you so much for joining us. Always a pleasure to speak with you. That's Ella Hoxha of Newton Investment Management. All right, Manus, let's get to some of the other top stories that are trending on the terminal this morning. China's central bank withdrew cash from the financial system, suggesting it views yesterday's abrupt surge in short-term borrowing costs as a temporary disruption. The PBOC drained 109 billion yuan from the money market by doling out a similar amount of new short-term loans than was maturing.
Well, Bayer has been ordered to pay $332 million in damages to a former land surveyor who claims his cancer was caused by using their Roundup weed killer. Bayer had won 9 cases in a row over the controversial product until October, but this is now the third trial loss in a month for the company.
Shares of WeWork plunged after the Wall Street Journal reported the company may file for bankruptcy as early as next week. In a filing yesterday, WeWork said it had been talking with creditors about improving its balance sheet and addressing its real estate footprint. Manus.
An Israeli strike, I should say, on Gaza refugee camp overnight has killed and wounded hundreds of people, according to the Gaza Health Ministry, drawing condemnation from across the Middle East. Let's get to Oliver Crook, who's in Tel Aviv. Ollie, where is the attention this morning? These headlines, perhaps, we need to consider where we are 3-4 weeks into this.
That's right. So the Jabalia refugee camp is certainly where much of the attention is focused today, where these strikes overnight, killing dozens of people. And again, it's hard to get exact figure on this sort of thing, but it's in the north of Gaza, just north of Gaza City, where it was one of the most densely populated parts of Gaza, which is already extremely densely populated. The IDF said that this is one of their strikes that was aimed at one of the leading Hamas figures, that it killed him and a number of other Hamas combatants. But of course, because of where it fell and because of the collapse of the buildings that we saw around there, drew condemnation from the Arab world and, of course, revived some of the conversations around the ceasefire talk that we've been hearing. A ceasefire talk which, of course, the Israelis have rejected out of hand. We heard Benjamin Netanyahu this week reiterate that. We also heard from the U.S. Secretary of State, Anthony Blinken, yesterday before the Senate. Have a listen.
When it comes to a ceasefire, in this moment, you're exactly right. That would simply consolidate what Hamas has been able to do and allow it to remain where it is and potentially repeat what it did another day. And that's not tolerable.
And we should say this was in a Senate testimony that was disrupted a number of times by protesters in the back who were objecting to the U.S. position in support of Israel. Many of the protesters had their hands painted red, as in red blood on the hands of the U.S. for supporting Israel. And of course, if the ceasefire is off the table, then what isn't? And perhaps this idea of humanitarian pauses in order to get aid in could be. All of this will be in focus as Blinken, as we discovered yesterday, will come to the region again this Friday.
And a lot of that humanitarian aid has focused on the crossing into North Africa, the Rafah border crossing into Egypt. What is the latest there in those efforts?
So we've seen more aid cross yesterday, a higher number than we've seen historically, still below the levels that were coming in before the crisis and before the war. You know, the UN and other aid agencies say they want to see 100 trucks. Yesterday was closer to 60. We understand there are more trucks flowing today, but the main thing that we're seeing today, and are the first people that are foreign passport holders that are actually crossing from Gaza into Egypt. This has not happened really since the war began. And also, we saw Egyptian ambulances going into Gaza and taking some of the wounded out of Gaza to field hospitals in northern Egypt. So these are two meaningful steps. And again, first of what we've seen since the war started on October 7th.
Oliver, thank you very much. Oliver Crook in Tel Aviv with the very latest. Coming up with Danny and I, the UK is hosting the first global summit on artificial intelligence. We're live to the summit. That's next. We have the UK Deputy Prime Minister Oliver Dowden on Bloomberg. This is Bloomberg Brief. I'm Manus Cranny in New York, Danny Berger at London HQ. Well, the UK is hosting the first Global Artificial Intelligence Safety Summit today at Bletchley Park. It's one of the birthplaces of computer science. World leaders are expected to attend, including Italy's Prime Minister and the US Vice President, Kamala Harris. Bloomberg's Lizzie Burden is on the ground. She has the UK Deputy Prime Minister with her, Oliver Dowden. Good morning, Ms. Lizzie Burden. How are you?
Good morning, Manus. Well, thank you. Yes, I am at Bletchley Park. This is where the code breakers cracked the Enigma codes back in World War II, and I'm joined by the man who's responsible for resilience in the UK now, Oliver Dowden, Deputy UK Prime Minister. Thank you for being with me. I wonder what success is going to look like in your eyes over the next 2 days. Have you already reached agreement on the draft joint communiqué?
Well, we are hopefully going to reach agreement on the communiqué later this morning. For me, this is about the huge opportunities of AI. If you think about how financial services and the City of London have so enriched the United Kingdom over the past generation or two, I'm convinced that AI can do the same thing for the UK over generations to come. But in order to achieve those opportunities, we have to reassure people about the risks.
So you're going to talk about that communiqué later. What are the main sticking points?
Well, I'm confident that we will get the communiqué agreed. What this is about is analysing the risks. And for the first time, we brought together the leading AI companies, the so-called frontier AI companies, alongside national governments and our security architecture. And what I'm hoping to do is we can reach a common understanding of those risks. And that's what we'll be discussing today. A range of buckets from societal risks to technological risks around weapons and so on, and indeed, ultimately, to consider this so-called existential risk.
Is there a risk by looking at that existential risk, you're getting a bit distracted from the salient challenges of misinformation and deep fakes?
Well, that's precisely why we're dividing it up into different categories. So I would say in the most immediate term, it is risks around misinformation, disinformation, deep fakes. And remember, what AI does is it proliferates those risks. So it increases the number of people that are able to create those risks. Things that were previously just the domain of national governments were at risk from hostile states. Many other actors, going down to your proverbial kid in their teenage bedroom, is now going to be much more empowered by AI. So we do have to take those risks seriously.
And how would the output of this summit interact with Joe Biden's executive order or the EU AI Act or the G7 Code of Conduct?
Well, we're closely coordinating with all of those things. So I was at New York for the United Nations General Assembly a few weeks ago, and I also took the opportunity to go to Washington and met with many of the President and Vice President's senior team to make sure we pull together and coordinate our efforts. This is about dealing with frontier AI risks. There's the President's voluntary commitments, which deal with AI more broadly. They also sit alongside the Hiroshima G7 Accords and other initiatives such as India and elsewhere. And indeed, many of the meetings that I've been having, for example, with Singaporeans yesterday, is making sure that these all work together to deal with a risk that we have in common, but deal with different elements of it.
Joe Biden, of course, isn't here. Is he stealing your thunder on AI?
Now, I think it's actually the opposite. So this all came about, if you recall, from a meeting that took place between our Prime Minister Rishi Sunak and President Joe Biden, and they agreed together that we would hold this summit. So our teams are working hand in glove together, and I think that's reflected in the fact that the Vice President of the United States will be here at this summit.
Well, does his absence leave more room for Chinese officials? Will they get to attend all of the events over the 2 days?
Well, the Chinese delegation is very important because China is a major AI power. They will be attending many of the sessions. I do think that there are some sessions where we have like-minded countries working together where it might not be appropriate for the Chinese to join. But we and China share these same risks around AI. Nobody wants some of the most adverse consequences happening, so it's right that we work with China.
So they'll attend many sessions but not all, and they share the risks, but fundamentally they don't share the UK's values. How can you reach meaningful agreement on how to regulate AI when it's going to affect pretty much all aspects of life?
Well, I think the common consensus we can find, and you'll see this today, is about a common understanding of the risks and of an evaluation of the risks. And that's why it's so important that we have the frontier AI companies here so that we can talk with them about where those risks lie, our concerns about them, and find a model for evaluating it as the technology evolves. We can't do what we've done previously, which is wait for the technology to evolve and then step in. But it is the case, to your point around China, that they have a different worldview to us, and we're very clear-eyed about protecting our worldview, whether that is democracy, rule of law, freedom. Now, some of those are not, as you know, going to be compatible with China, and that's not going to stop us from taking the steps necessary for our nation.
Another controversial guest here is Elon Musk. Earlier this year, he called for a pause in AI development. By featuring him so prominently here, do you risk being seen to endorse his views, including on Ukraine?
No, we don't endorse many of Elon Musk's views, but Elon Musk is an indisputable tech titan, and it's a sign of the importance of this conference that someone like Elon Musk is here, and it's a sign of what this conference is all about. I've been to many international conferences, as I'm sure you have as well. They tend to be businesses or government. This one is bringing the two together because AI is being innovated by those frontier AI tech companies, but there's a duty on government to protect its citizens against those risks.
Well, Mr Dowden, we look forward to the rest of the conference. Oliver Dowden, UK Deputy Prime Minister, thank you.
Thank you.
Danis, Manny, back to you.
Lizzie Burden there. Thank you very much. We're going to continue our coverage of the AI Summit today. Tom McKenzie will also be on the ground there speaking to the CEO of DeepMind later today. All right, here's a story that caught our eye this morning. Manus, more or less, Saudi is set to host the 2034 World Cup, but here's the kicker. It doesn't have any rivals. That's why it's hosting it. Australia at one point was the rival. But yes, I mean, it's true, right? Australia dropped out. Saudi is hosting it because they're the only option.
Well, you know what? They're going to have to build an awful lot of stadiums. You're right. I mean, you were looking at the FT story, and we've obviously got the same story. But it's about, well, if you create a structure where virtually nobody else in the world can bid for it, and the Aussies drop out, and that sort of leaves you with the last person standing, doesn't it? But in terms of stadiums, believe me, I know a thing or two about stadiums in Qatar in the heat. It's very hot, I assure you.
I was going to say, there's a video out there somewhere of Bloomberg TV of me asking Manus to do like a header or something with a football, and he does it. It exists out there, folks. You got to go find it on the internet.
It's one of those moments when I said to the producer, can you bring me a football? I want a football. I want a football. And he goes, okay, get him a football. Why he wants a football? And yes, I did do a header outside the Al Sail Stadium. They need 14 stadiums of more than back to the story. They need 14 stadiums of more than 40,000 seats. No, I'm joking. 40,000 seats. They've got 2.
But I mean, they're building out there anyway, right? We've heard of all of these top talent that they're trying to bring to Saudi football teams. So, I mean, they're already going down that route. It's a bit different than Qatar, isn't it? That they're not necessarily starting from scratch. They've already expressed an interest in having a really strong local football offering.
Look, definitely they're not starting from scratch. There's no doubt about that. They've also got the Asian Cup in 2027. So they are going to have a lot of infrastructure. It depends where they're going to have it, in Riyadh or Jeddah or in the higher mountain areas. But of course, those are the key cities. Those are where the key airports are. So I would imagine, I would imagine that you will have. I mean, they've got some amazing footballers that they've signed up, from Ronaldo to Neymar, etc., all ready to play.
Manus, I just want to know, when the World Cup is in the U.S. in 2026, are we going to go to some matches together?
We're going to be there. I'm going to be doing headers. I'm going to be all over it like a rash.
Can't wait.
Welcome back to Bloomberg Brief. I'm Manus Craney in New York.
And I'm Danny Berger in London. Here's what you need to know. A well-telegraphed pause policymakers are poised to hold for a second straight meeting as bond traders brace for the Treasury's quarterly funding announcement. On standby, Japan's top currency official says he's ready to intervene in the FX market if needed. The BOJ announced bond purchases as yields touched a fresh decade high. And Antony Blinken is set to head back to Israel. Dozens of people were killed and more wounded at a Gaza refugee camp, stoking concerns about the mounting toll from weeks of fighting. All right, let me get you your check on equity markets this morning. You are looking at lows for the futures session in both the S&P and NASDAQ. NASDAQ down about 0.4%. It's been a heavy week in terms of earnings. We've had some cracks show up in this equity market. J.P. Morgan, for their part, the asset management arm, David Kelly, says that now we're looking more in line with historical norms when it comes to valuation. So buy value, but maybe don't buy tech. Well, we're certainly not buying tech today. Again, as I mentioned, it is underperforming. Citi also mentions that investors are loading up on protective options ahead of Apple's earnings. That hits tomorrow after the bell, so we'll have a big event. A lot of other earnings on their way too today. Qualcomm, Airbnb, for example. European stocks, Manus, those are doing better, up 0.2%. Maybe some sideline waiting ahead of today's big show of the refinancing announcement and the FOMC. But Manus, at least so far this morning, it's not the Fed, it's the BOJ that's taking the spotlight.
Absolutely. And we've just heard from Ella Hoxha at Newton saying they've shot themselves in the foot. The Ministry of Finance stands ready to intervene. These markets are nervous. You've got fear of further intervention from the Ministry of Finance. You've got the Fed and you have funding concerns. But what you have is just a small pivot in dollar yen. We're waiting to see, will the market test 151.90? That is a 33-year low. We haven't quite done it yet. But this market is irked by the fact that you saw the Ministry of Finance come in and get themselves involved in an unscheduled bond buying program. Canada stands ready. We are on standby to buy. So again, a little bit of two-way action in that market. But what a beautiful line from Newton, that they've shot themselves in the foot. And by the way, you'd prefer to go dancing with a lush FX market than a constrained bond market. That's all I'll say to you. Now, when it comes to the short end of the curve, let's see what the funding is. It's not going to really impact the short end of the curve. But Henry Druckenmiller certainly is. He obviously went to a bit of lunch or dinner with Bill Gross or Bill Ackman, because he says he's got massive bullish bets on the short end of the curve. I started to get really nervous. I bought massive leveraged positions. And of course, this chimes with what he's concerned about in the soft data, the anecdotal data. You talked about the consumer confidence, didn't you, Danny, a little bit earlier? But the quarterly refunding number we know is 114, well, not we know, we expect it to be 114 billion. Will that blow the socks off the bond market?
It's interesting, though, because all of that also chimes with what Ella said to us, too. I mean, she liked the idea of getting back into this bond market. She said she's not maxed out on duration, but there was a hesitancy, Manus, to not go all out as maybe Druckenmiller or the Bills, because do you really want to risk catching a falling knife in this market?
No, and she actually said we're positioning the portfolios based on the idea, albeit a tail risk, that you could get rates at 6%. And with that in mind, I said, do you want to wear the crown of duration, Hunter? She said that is a very tough crown to wear, but they are tepidly adding to that duration over at Newton. You got a little bit of data, Danny.
I do. A little bit of breaking data on the UK. PMIs coming in, manufacturing coming in weaker than expected. Manufacturing PMI for the month of October, 44.8. The preliminary number was 54.2. So that is a pretty solid revision downward. Now, we're going to talk about the BOE in a little bit, but before we can tackle the Bank of England's decision, we have to tackle the Fed's decision. It is posed to hold interest rates steady for a second meeting, but is leaving the door open for another hike as soon as December. Joining us now is Jumana Saleheen, Chief Economist at Vanguard. Jumana, really great to speak with you this morning. Okay, I promise we're going to get to the BOE, but I do want to just start with the Fed and the potential for any surprises to come from them, because we have this really confident feeling of it being a hawkish hold. What could shake up the narrative today?
I mean, I think really it's all going to be about the language and the communication today. So the Fed's going to be weighing up two factors today. First of all, the 10-year bond yield has been rising by about 100 basis points over the last 3 months. So that's a tightening of financial conditions, which is going to weigh on economic activity and slow the economy, as the same as a rate hike would. So that's already there. The second thing is the economy is strong. The latest GDP figures were, just under 5%. Real growth. That's double what we think potential growth is. And so the labour market's strong. Yesterday we saw the wage data come out, the ECI. So the Fed's going to be weighing those two factors. It's going to be a fine call, and they're going to use their language really to signal that it stands ready to hike if necessary.
Jumana, good morning. Good to see you. You touched on the ECI, and of course we looked at that. That came in at, 4.3% on an annualized basis. That's slightly different to the Atlanta Fed, which saw theirs slow. But when you look at wages, how hot are they? And does that deliver scope. Our last guest said there is a risk, albeit an outlier risk, that rates would have to go to 6%. Could you see 6%, and what is it that would happen economically to take us there?
I mean, I think, the wage data that we saw yesterday, if you look at the Atlanta Fed, yes, it's a little bit weaker. But on the whole, those wage numbers are consistent with inflation of around 3.5%, not the 2% inflation target. So they're a little bit hot, if you like, and we do see those wages, coming down as the economy cools, as the past interest rate hikes continue to work through the system. What do we have to see for those interest rates to continue going up to 6? That would be a scenario where, what people call the no landing scenario, where the economy turns out to be stronger than expected. We get further surprises on consumption, on growth, on the labor market, and that forces the Fed to say, hey, you know what? We have to go more because the economy is not cooling, and also the real interest rate, which is really what matters. There's a lot of uncertainty about the neutral rate of interest, and could it be that that neutral rate is higher?
Yeah, we're getting into the stars, Jumana. I like it. I guess one of the confusing things, though, is you do have labor data, for example, that's really strong. A lot of the hard data has been very strong, but you look at the anecdotal evidence. It's something that Juncker Miller talked about in the report we saw from yesterday. You look at Caterpillar saying that their backlog has shrunk significantly, and then you have these fears that industrial production in the U.S. has peaked. How much credence do you put on that sort of anecdotal evidence?
Yeah, there's a lot of uncertainty out there right now with respect to where the economy is. And you're absolutely right to say, Caterpillar, construction sector. We're not seeing that weakening, and it's one of the first things that you would expect to see weakening. So the signals are very different, and that's because we've come out of some unprecedented big shocks, the pandemic. People are still building those shortfalls in housing, which, they weren't able to do so during the pandemic. So, a lot of those spillovers are continuing into the economy. And the other thing I want to really mention is fiscal policy. That surprised us on the upside. Some of the, the CHIPS Act, the Inflation Reduction Act, the spending has come much earlier in 2023 relative to CBO expectations of them being in 2024.
It's just a question of maybe when pandemic and when the fiscal largesse perhaps runs out. Can we draw on your expertise from your days at the Bank of England, Jumana, which is, excuse me, I'm surprised that you've penciled in perhaps the risk of another couple of hikes. But again, of course, the data is brutal for them. But Danny just broke the PMIs, which don't look that brutal, but we know that it's a tough time in manufacturing. But again, going back to wages, going back to the inflation narrative, going back to the bulk of the legwork has been done. You've come in with 2 more hikes. How assured are you that that's what it's going to take to tame the beast of inflation in the United Kingdom?
I think, Manus, where we really are is, we look at those fundamentals. You're absolutely right to call out the PMIs. The soft data is definitely indicating that there's weakness in the economy. The hard data, I would say, is much more mixed. And on the labour market side, we've got measurement issues in the UK which create a fog around really understanding what the labour market is doing and how much, it's really easing. We don't really know because of the response rates from the labour force survey have fallen to, historic lows. So we've really got some confusion there. Our call there of, a couple more hikes, that's really based on, as you said, inflation, core inflation, wages. We talked about the US being around 4%. The UK is double that. It's closer to 8%. So we really think to get inflation, take the risks off the table, we needed those couple more hikes. And we know that the Bank for International Settlements have said front load those hikes, right? Yeah. So in the UK, there's a few more challenges.
Just to get back to the data point, I mean, the data has been so confused. You mentioned the low response rates. In the beginning of September, there was this whole brouhaha about huge revisions from the ONS. Some of the figures we thought were really bad, fewer goods and services than the pandemic. Rather than producing fewer, they actually exceeded the benchmark. I mean, it was really big provisions. How frustrating is this data? I mean, how can you kind of trust the usefulness of some of the data coming out of the ONS right now?
I mean, look, the data is always an issue because, you have an initial read, and then as you get more and more responses and more information, there are those revisions to the data. So that's in general a good thing, right? The picture you get more information, you update that information, and you revise your data. So that's really great. Obviously, with the pandemic, there have been big changes from face-to-face interviews to phone interviews, and that's really where we've seen, quite a lot of challenges.
And someone like me would never pick up the phone. So I hope they're not calling millennials.
Should be by text, right?
Yeah, exactly. WhatsApp. So, I don't know, Instagram DM maybe.
That's right.
Yeah, Manus, jump in here.
Yeah, they're all. But then again, the construct of work has completely changed. I mean, the number of people that I've met here that are doing 2 days in the office, 3 days from home. I know that's perhaps not the norm. I know that back to work is very much on the rise. When you look around the world, the Aussies are unsure that they're done with rate hikes. The Fed is unsure that they're done with rate hikes. And you're pretty darn sure that the Bank of England is not finished with rate hikes, which takes us then to how brutal will inflation spike or respike be in 2024? Because everybody has come in here and said inflation is pretty much beaten. It's the last mile now. But of course, if you look at what elements are bubbling in inflation, it's the elements that perhaps didn't bubble just immediately post-pandemic. So how hard will a resurgence of inflation be as a risk for you 2024?
So, Manus, if you've ever run a race or a marathon, the last mile is actually often the hardest mile, right? So I wouldn't be kind of like declare victory yet.
Right.
I don't think I'm talking about a resurgence of inflation. What I'm really talking about is the stickiness of inflation around current levels. So a lot of what we've seen so far is the easy part, right? The oil prices that were high, the energy prices, the food prices, they've fallen out of the calculation. And yes, inflation has come down. But the last bit is really on the core side. And, I don't really think that we've seen much of that come through as of yet.
All right. Still got to make it through that last mile. Jumana, really wonderful to have you on this morning. An exciting 48 hours to come. Thanks for setting us up for it. That is Jumana Saleheen, Vanguard Chief Economist and former BOE Head of Financial Stability. And stay tuned for Bloomberg Surveillance's special coverage of the Fed decision. That will kick off at 1:30 p.m. in New York, 5:30 p.m. in London. Now, coming up, we're going to talk tech. AMD has fueled optimism on its new AI chip. The company says it will offset its dull forecast, but pre-market shares move lower. This is Bloomberg. Welcome back to Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. Now, AMD is hoping to look past its mild forecast. It highlighted in its earnings a new AI chip that AMD said will generate $2 billion in sales next year. Shares, though, pre-market down more than 2%. Joining us now for more is Bloomberg's Alex Webb. Alex, it feels like not that long ago where you don't even have to say you have a new AI product. You just have to kind of sprinkle the word AI in your earnings release and the market with gangbusters. Is that era over?
Well, I think the thing is actually with the AMD, people thought that it was very much big in the AI space, that it is the alternative to NVIDIA, and in many ways that is true. It's just it's a little bit behind the curve. It is coming out with these products a little bit later than NVIDIA, which is already iterating on the next generations, having really dominated that first flush of AI spending. The other piece, of course, is that the rest of its business is not doing brilliantly. When you think about particularly its gaming equipment, it makes GPUs that are, or add-ons that are, for gaming. That business, people aren't it's discretionary spending. That spending isn't really coming forward. There is optimism about this, the prospects for these AI chips. What is quite interesting, if you look at some of the multiples, it trades at a very similar multiple to NVIDIA. It is actually significantly less profitable than NVIDIA. So actually its net margin is a lot lower than NVIDIA's. It's partly because it's been spending on developing these chips. With an expansion next year, then it will start to look like it's trading at a significant discount to NVIDIA.
So, Alex, we're also going to get Qualcomm off a little bit later on. They've made some pretty big assertions about what they want to do in terms of making inroads into the PC market. And I quite like the line in the story is they've got to stand those up in size. Do you think that they will?
I don't know. I don't know if they will. They've certainly got big ambitions. They're spending, heavily to get into the space. It is a space that has historically been dominated by Intel. Apple managed to take chunks out of Intel by, building their own chips for their computers. The question is, who are the end customers? We don't know for sure that they have those lined up. They seem very optimistic. They kind of need it to offset the declining sales in smartphones. There have been at various junctures some rebounds in PC sales. Right now doesn't seem like a brilliant moment. But heading into next year, when there's a little bit more capital people might hope, then there is an opportunity.
Alex, I just got, this is very serendipitous. I just got a note in from Deutsche Bank in my inbox that we've written up, and I just want to get your take on it. I know you haven't seen it yet, so this is fresh and exciting. Here's the headline: firms that talk AI more see their shares underperform. So companies that have discussed AI more in their corporate earnings call this year have tended to underperform the wider market, according to Deutsche Bank analysts. I just want to get your take on that, what you make of that. Because, again, it's kind of what I started with. I thought AI was the thing that saves tech.
Look, they've got to deliver on these things, right? It's all very well talking about them in earnings calls. Sometimes you wonder if you talk about it too much. Perhaps this is the thesis that you're actually trying to use it as something of a fig leaf for underperformance elsewhere. The thing we are seeing with NVIDIA is that they are starting to deliver on this stuff. The thing we're seeing with Microsoft, they are delivering on this stuff. Right. AMD is not quite there yet. Doesn't mean they won't deliver, but it's very much looking like something for next year rather than something that we've seen historically.
Yeah, such a good point. Microsoft discussed AI, and they rallied because good things are actually coming from it. Alex, thank you so much for joining us. That is Bloomberg's Alex Webb. Let's turn now to the world of hedge funds, because we have a lot coming out from the space. Take a listen to what Skybridge Capital founder Anthony Scaramucci had to say.
We're on a good run right now. The month of October has probably been the best month in Skybridge's history, for that matter. A lot of it's Bitcoin, some of it's tech, some of it's newer economy things that have rebounded aggressively since the beginning of the year.
So Scaramucci says he's on a good run, Manus, but he's not the only one. It's been a pretty good quarter for the macro hedge funds.
Yeah, and they're probably getting a little bit more involved in the bond market than they used to, Danny. If you look at the price volatility and the volatility moves in the bond market, it's appealing for hedge funds to get involved there. But Anthony's never short of a headline. He was officially invited, just a shout out to Anthony. He was invited to come in early. He just didn't respond to the WhatsApp. Let's talk about it's not just Skybridge, of course, as I said to you. We've got this whole sort of macro hedge fund trading bouncing back. You got the vol rising in some of the biggest markets, and the best performing hedge fund strategy in the third quarter. So asset weighted returns, Danny, if you look at that, the macro funds hit 3%, while the multi-strategy and equity funds saw losses of around what, 1 to 0.5%, 1.5%, I should say.
Okay, I'm going to rain on the parade here, Manus, because macro hedge funds are still down almost 2% on the year. Yeah, they had a good quarter, but they're not making up for it. So many folks got married to their position of 2022 of shorting everything, which paid off a lot for them. Let's be clear here. But in the beginning of 2023, it did not pay off. We had an equity market that continued to rally. And, of course, that period in March after the banks collapsed and Treasury markets rallied, that caught a lot of macro hedge funds off guard.
Yep, let's see what the close of the year, how much risk do they want to take before the end of the year.
All right, Manus, we also have more on this on today's Big Take. Big Take is where you want to go. It's about hedge funds focused on the Treasury market. More volatility, Manus, there means bringing in more bucks. Coming up, we are going to talk about the things that you need to know to get your day going on Bloomberg. It's Bloomberg Brief. I'm Danny Berger in London, alongside Manus Cranny in New York. Let's get you set up for your trading day and a look at what's ahead. 8:30 a.m. Eastern, the U.S. Treasury will announce its debt refunding, which many believe will outweigh the Fed's rate decision. That decision, it comes at 2 p.m. It'll be followed by Chair Powell's news conference at 2:30 p.m. The central bank widely expected to hold rates steady. And then we've discussed some of these, Manus. It's a big day of earnings. We got Qualcomm, MicroStrategy, PayPal, Coca-Cola, Coca-Cola, Airbnb, they will all be reporting today. How much can they fight through the noise, Manus, of these huge macro events that already have bond markets on edge?
Well, it depends. If they deliver well, they'll probably be rewarded. You saw last week the slightest chip in the wall, excuse the pun, and they were brutally punished. Of course, Coca-Cola raising prices. You're still going to buy your Coke and your Coke Zero, but are you going to notice a 9%, 10% price rise? There's no doubt about it. This market has been put on a global watch today. You got the fear of intervention from the Ministry of Finance. You've got the Fed in terms of quarterly refunding and the FOMC. And I think you just generally have a level of fear that something, to choose your word and a number of guess words, pernicious could happen. But these bond markets are incredibly important, and the Ministry of Finance has put us on warning in terms of they stand ready to intervene in the FX markets.
Yeah, I mean, Druckenmiller said that given we're pulling down on pandemic spending, it's just a matter of when something breaks over the next 2 years as folks start to refinancing. We spoke to Ella Hoxha over at Newton Management. It's interesting to hear her agree with the bond bulls, but say we are still being really cautious. Manus, the sense you get in this market, even if you say, wow, look at the yields across this bond market, even if it looks attractive to you, do you risk catching a falling knife if you jump in?
Well, as I said, I think my favorite one is we're going to have this hawkish pause from the Fed, but Druckenmiller has these massive bets on the very short end of the curve. So people are worried that something is going to crack in the edifice of the consumer and something more malevolent is going to happen going into 2025, maybe even before the end of 2025, the end of 2023, going into 2024. I'm a year ahead.
I'm barely ready for this year to end, Manus. I'm not ready for 2025, please. All right, that's it for us on Bloomberg Brief. Surveillance, that's up ahead on Bloomberg.